Thanks for tuning in to the Motor Research channel. The content in today's video is highly relevant to current market conditions, but it is last month's video. If you like what you see, you can head over to our website to get a 1-month trial, which will give you access to all of our current and prior research and videos. See the link in the description below. Be sure to like this video and to subscribe to our channel to be notified when we post more valuable content. Enjoy the video. What matters, and I say this, I try to say this as often as possible, but what matters more than the fact that the market is selling off is the health of the market before the selling began. So that tells us whether or not the market will be able to endure price weakness, because price weakness is just a feature, not a bug. It happens all the time, happens in bull markets, happens in bear markets. There's nothing we can do about it. So all we can do about it is to assess the market condition so that when it does happen, we have a good sense for whether or not a 5% decline will result in a 20% decline as it does in bear markets, or a 5% decline will result in new highs as it does in a bull market. And today I would just say that the structure is just too good to sell into weakness. So our tactical strategy for this uncertain period remains the same. We want to focus our attention on one 5% swing at a time, because we don't really have conditions that support the idea that we're in a robust bull market yet, but we also don't have conditions to support the idea that there's an impending bear market. So in that environment, we just want to handle this 5% swing at a time, and we want to be buying oversold conditions, which we're not there yet, but we're getting there. And so we want to be leaning into buying that weakness and then just monitor the subsequent rally to see how healthy it is and how much structural repair work we can do into those rallies. So in the meantime, the change that I want to highlight is that this stealth bull market notion that we've been talking about in our notes and in these videos for the past several months is gaining some credibility as a potential scenario. In other words, the market may not be as weak as it appears, or it may be stronger than it appears. So in this video, what we're going to cover is we're going to just focus on those levels that need to hold for the S&P, the Nasdaq, and the value line, as well as NVIDIA. And we'll also take a look at a couple of other markets that may hold some importance for the equity market in the months ahead. So as always, I want to begin with a review of the current technical structure of the market, because ultimately, as I said, this tells us what the health is of the market as it has to endure this sell-off. And what we can see here is, just to give a quick review, over here is this is our trend model. And we can bucket the trend of these 2,800 stocks that are in the motor universe. We can bucket the trend into these different trend buckets. And when we do that today, what we can see is that the biggest bucket across all of the different time frames, this being quarterly, monthly, and short term, the biggest bucket is uptrend. So when you look across these three timeframes, the biggest bucket looks like this. And when you look at if you add up all of these categories here, which are all the different uptrend categories, in the quarterly time frame, you get 59%. So the majority of quarterly charts are bullish. The biggest bucket looks like this, and then the rest of them look like this, which is not bearish. And then you do that same analysis in the monthly time frame. The majority are bullish, and the majority are bullish in the weekly time frame. So there's two things we can say about that. One is that the majority are bullish, which gives us the evidence to suggest that weakness should not be sold into. But we can also say that yes, it's the majority, but it's not the vast majority. And when we are in a robust bull market, which I can argue that we really haven't seen one since probably 2012 to 2016. That was the last really truly vibrant multi-year bull market where both the S&P went higher like this, but so too did the average stock. It's been that long since we've really truly had that type of a bull market. And when you look here, we can see that it's not the vast majority of stocks. So we're not yet in a robust bull market. And we can also see that although we're experiencing some weakness here, the 64% of the stocks in the motor universe are still above their short-term moving average. So we're not quite yet oversold. So I think we still got some more weakness to go through here and more selling. But when you net all of this out, when you're talking about price trends and momentum and relative performance and volatility and market breadth, those are the things that all come together to populate this risk gauge. We can see that this is on the brink of being risk on. And that, again, that's just not as painful as this recent market action feels. It's just not bearish. It's not the kind of weakness where you get 5%, you should anticipate another 15%. It's more, if you get 5%, it's in that vicinity where you should be expecting weakness. And what we want to dovetail that with is momentum. And when this gets oversold in this condition, we want to be a buyer of it. Now, another thing we can look at it also is to measure these models across the various market cap quintiles. And so this is the top quintile of market cap, which we know obviously has been what's been driving the bus. And so if that's the leadership and has been the leadership of this bull market, then we want to just make sure that the leadership of the bull market at least remains healthy as this sell-off is ongoing. And when we do that, we can see that uptrend, which again looks like this, is the biggest bucket across the 3 timeframes. And across the 3 timeframes, it's the biggest bucket when measuring the percentage of market cap. And when we look at the percentage of stocks in the top quintile, it's the majority of charts in the top quintile of market cap do have bullish structure. So again, this is just an environment where, as we get a 5% decline in this market, we don't want to be a seller into it. In fact, we want to be a buyer. Now, as it's interesting to note that only 51% of the top quintile is above its short-term moving average, which is not as many as the broad market, which indicates that the broader, smaller companies, the other quintiles of market cap, are actually still more overbought than the top quintile, which is part of what I'm talking about. We're starting to see this more robust overbought condition in the smaller market cap quintiles, indicating that we may be transitioning leadership. But for now, what we can see is that, yes, it's still overbought. And as I'll walk you through this, there's still more reason to anticipate potentially more weakness before we can be a buyer. But that's my thinking as it stands today. And what I think is interesting to look at is this reading, which I featured last month on the smallest, lowest quintile of market cap, which we see here is quintile 5. Looking at the various trend categories in that quintile last month, the biggest bucket across the quintiles, across the timeframes, was charts that look like this across the 3 timeframes, and the biggest quintile of market cap in the short term looked like this, but that was in the context of not a terribly bearish looking setup for the lowest quintile in terms of market cap, but nonetheless it was certainly not robustly bullish. But when you netted it all out, all those things, you netted out into the risk gauge, it was just sort of table pounding neutral. And again, that's just not a bearish environment. It's not bullish, it's not robust, it's not something you can get all excited about, but it's definitely not bearish. And in that context, only 28% of the lowest quintile was above its a short-term moving average. So this was an oversold kind of neutral condition, which is why we were endorsing the idea of buying the weakness. Now, when you compare what's happened to this quintile since then, we actually see quite a bit of improvement. We don't see the biggest bucket yet in the quarterly time frame in the smallest quintile to be in an uptrend, and we also still see the majority of charts, which you get when you add up these here, are still in some sort of negative configuration. So that's, again, just shows you that it's not robust yet. But this can't get better, and this IE cannot get robust until these timeframes get robust, and we can say that they are certainly well on the way to doing so. Now, all of this translates over into the risk gauge, into a situation that's getting at least leaning to the bullish side of mixed, if it's not a bit better than that. And here's what I think I want to highlight: as we're going through this sell-off, we actually still have the lowest quintile of market cap is still overbought, and that might sound bad, but it's actually perversely and interestingly, almost inversely, potentially bullish, because it's just showing that there's a lot more upward momentum taking place in the smallest market cap quintile, and this robust overbought condition has resulted in trend change. That's what's important about this. And so this is an early indication that we may have this top quintile handing off leadership to the lower quintiles. So something to keep an eye on as this oversold condition plays out in the coming weeks and months. As I said, market weakness is not a bug, it's a feature of both bull and bear markets. So I think, at least as we just showed you in the top quintile of market cap, and certainly in the Nasdaq and in the SPYs, we're in a bull market. That's undeniable. Being able to draw that conclusion. Now, what we want to focus on is not so much the fact that we're getting a sell-off, but is the sell-off doing any damage? Because that's all that matters. You can't avoid sell-offs. So all we can do is understand the condition leading into the sell-off, and then how the condition prevails during and throughout the course of that sell-off. So these are the levels that I think we just need to focus on for the next several weeks and months, probably into the September, October window for the Nasdaq 100. So yes, it would be painful to see this unfold, but that the market doesn't care about that. The market is going to do what it's going to do, and we just need to keep in context that volatility and weakness in terms of that long-term ongoing trend. And in the way I'm reading it today, again, because these are monthly and quarterly levels, they'll change a bit in the coming quarters and months, of course, and they'll begin to gel and kind of like back each other up and overlap a bit more than they currently do. But this is where they are today. In the coming months, I think we can maybe just say, more generally speaking, that perhaps somewhere in here is the zone that's going to really matter the most as these levels begin to gel a bit better in the months ahead. But as they stand today, you can see that we're starting to enter that zone. So the idea is that as we get into these support zones, we don't want to be selling. We want to be actually, if we want to be selling, save it for the next overbought condition. Don't sell into this oversold condition. And of course, if it's true for the Nasdaq, it's true for the SPY as well. And so these are the levels that I think you want to focus on in coming weeks and months. And as we get into these zones, you do not want to be selling into these zones. You certainly don't, if you're a hedge fund and you can short, you certainly don't want to be shorting into these zones. If anything, you want to be covering shorts and potentially layering on some long exposure. Same thing can be said of the value line geometric average, but I think actually this is the most important average to focus on. It's a bit frustrating because I generally don't like discussing this average because it's not representative of capital growth and destruction in the market. It's really just a good representation of market breadth. And as we know, and I've kind of highlighted this repeatedly in past notes and in videos, but value line geometric average is just what the average stock is doing. During robust trends, whether they're up or down, this index tends to move in the same direction as the S&P itself. So the last time we had a robust trend was to the downside. The peak in early 2022, late 2021, into the October bottom, both indices moved in the same direction, thereby signifying that it was a meaningful bear market. Now, what we know is that since this low, the S&P is way up here now, out to new highs. But what we can see is that the average stock has not participated. So this is just not a robust bull market. And to quote the Art of War, that this bull market is not as strong as it looks. So in what I'm arguing is the notion that it's potentially transitioning to an environment where, as the popular averages might look weak as those mega cap names come under pressure, thereby pressuring the indices lower, the market may actually not be as weak as it looks. So to keep that notion alive, we want to really, during this weakness, we want to just focus on levels that really matter. So as it stands today, I think the level to focus on in terms of resistance, we need to get above here, in other words, to really signify the beginning of a robust bull market. I think the 620 to 643 zone really needs to give way on the upside to really ignite the bull market. But as we go through this condition, or this sort of sell-off, and we're looking for that next oversold condition, ideally we'll hold above this level. If not, we'll at least hold above these other lows that have been hit throughout the course of 2024. If we get below these levels, clearly that won't be ideal. It would potentially unlock a test of the monthly and quarterly support zones that exist down in the low 500s. As it stands today, given the structural condition that I detailed in the first couple of slides, I don't think that's what's in the making. What I'm more thinking is likely to happen is that we end up getting more of a sideways condition here that holds above the top half of this prior range, while the mega cap names correct a bit more, and then everything begins to move higher off the October bottom. That would be the best case outcome. And as I said at the outset, let's just monitor this 1-5% swing at a time. But that's my thinking going into this. Obviously, it's also very important to keep our eyes on the most important stock, which is NVIDIA. And I think things can get really interesting for NVIDIA in the coming weeks and months, keeping in mind that this is all happening with the backdrop of all the excitement surrounding AI, and how NVIDIA is the picks and shovels, and that AI can't happen without NVIDIA, and all these other things that are awfully reminiscent of how we thought about Cisco in 1999 and 2000. And yes, Cisco went on to deliver the internet, but while it was doing that, it also dropped 90% after having reached 38 times sales. So that's, again, I always say this, but we're in this window right now. So I'm going to just continue to repeat it so we don't lose sight of it. But this is the difference between a great company and a bad stock. It's valuation. And Cisco's problem wasn't that it was a fraud. It wasn't that it wasn't going to deliver the internet. It did all that. It wasn't a fraud. It was a great company. It delivered pretty much all the hype that was built into that valuation. But while it was delivering that hype, the stock went down 90%. And that was while revenues continued to grow and accelerate, I might add. So that, to me, is the risk for NVIDIA. It's not that it's not going to deliver AI. It's not that it's not an important company. It's not that that it's a fraud or anything like that. It's just that it's trading at 38 times sales. So it's got that headwind ahead of it. So I think this is the most, sort of, in my mind, the most lucid way to be thinking about this situation. So these are the support levels for NVIDIA going forward. And I personally expect a full test of these support levels in the coming months. So if all goes, quote unquote, to plan, then the September to October window, which is the most common window of the calendar for a major market bottom, and of course it might extend a bit further than that given the oncoming election. I think we should be open to the possibility that NVIDIA kind of looks like this over the next several weeks and months. Now, a little bit tongue in cheek here, but I think this is just something to think about. I've already detailed all the reasons for why I think NVIDIA is at risk, despite the fact that it's a great company and that it's going to deliver AI. But this is what we see at major valuation peaks in super exciting stories like this, where the CEO is ordained a rock star. And then in this case, the CEO of NVIDIA, I think it's clear that, I mean, the black leather jacket aside, looking like a rock star to begin with, the fact that at a recent conference he was signing the chest of a quote unquote fan at the conference. I mean, I can just say that 5 or 6 years ago, when NVIDIA's price to sales ratio was 2, and nobody knew who the CEO was, he wasn't walking into conferences signing T-shirts of the adoring fans. But that's what's happening today. And this is just so classic of what it looks like at a top. So much so that I'll even throw out there that I wouldn't be surprised if the CEO of NVIDIA is actually named the 2024 Time Magazine Person of the Year. This is what happened to Jeff Bezos right at the peak in 2000. He was named Person of the Year right as the stock peaked. It was right around 50 times sales. And that stock went down 90% at the same exact time that the revenues went up threefold. So the revenues tripled while the stock dropped 90%. So I just think all these benchmarks for classic speculative valuation peaks, I think they're there, and I think it's hard to accept. But I think we need to really open our eyes to the possibility that that's what's in store for NVIDIA and perhaps the other companies that are similarly hyped as it relates to this AI trade. So obviously the conclusion there is don't own NVIDIA, which is something that I fully endorse if you haven't figured it out yet. Now, I will own NVIDIA again if it gives me that proper setup, which I did earlier in the year, but the setup played out and I don't own it anymore. But I will own it again if the setup is presented. But what this slide is to demonstrate is what happens if every single year you just own the 10 largest companies. And when you do that as a strategy, that's what you see in this brown line here, right? So obviously it's not a catastrophe. It's not like you lose money, but you underperform the broader market. So this is the S&P 500, and you underperform by just focusing your ownership on the 10 largest companies. And of course, the blue line is what happens if you own the other 490 companies. So obviously I'm tongue in cheek here, but I'm labeling this David versus Goliath. So generally speaking, just as a course of action, it's generally safe to not own the 10 largest companies. That's obviously not true every single year, but by and large, over time, it's safe to do your fishing in the pond that has the other 490 companies and don't fish in the pond that has only the 10 largest companies. That's generally a safe thing to do. But given the bubble conditions that I believe prevail currently in the process of unwinding, I think it may be safer than ever today to not own the 10 largest companies. Something to think about. We'll wrap up here with just a couple more slides. As we're going through this corrective period, in the market throughout the course of the next several weeks and months, I think we should just keep an eye on the VIX, the volatility index. And if we get readings in this 25 to 30 area, I think those will be good tactical indications. As you can see here, that's generally a good indication of a tactical low. Now, obviously, in really heated bear markets, in more extended bear markets, and certainly like this was COVID, we can get much worse and more sustained and persistent readings above 30. But I think if we get into the 25 to 30 area, with the structure as it is today, I think that's going to be a good tactical buy signal. And then we can also look at what we call the VIX curve. So the VIX has many different timeframes of contracts, 1 month, 3 month, and even further out. And what we can do is we can compare the levels of those different timeframes to each other for indications of excessive selling. So typically under normal conditions, people are more worried about or uncertain or unsure about the future. And they're more certain and more positive about the more near term. So as a consequence of that, the normal structure of the VIX market is that the contracts for 3 month and 6 month volatility tend to be higher than the contracts for the 1 month volatility. That just reflects the idea that people are more certain and less concerned about the very near term than they are about the more distant future. But when selling really starts to get going in the market, people start to become a lot more concerned about the present because they can feel the pressure of the current selling. And it sometimes can get so strong that the 1 month contract can actually get higher than the 3 month contract. And what we can see in here is that a good tactical buying level is somewhere between 1 and 1.2. So this will be one of the things that we also monitor for the next several weeks and months throughout the ongoing course of this corrective activity that we're anticipating, is that when we get a spike in the VIX to north of 20, somewhere 25 to 30 perhaps, coincident with a VIX curve that's somewhere between 1 and 2, that will be a good tactical signal that you should cover shorts, stop selling, perhaps do some buying. And I think this will be a good guide for us to focus on. And of course, we'll cover it in the upcoming research notes that we write intra-month. And then I think this is an important market to monitor as well, because it's, if I'm being honest, I'm not quite sure what kind of an impact it's going to have on the equity market, but I can say just, exclusive of that, just looking at this trend and drawing conclusions from what we know about how price action behaves relative to trend, various trend elements, support levels and resistance levels. If I'm just looking at this and just trying to be as neutral about it as possible, I have this view that Treasury yields can go higher from here. And this is, as you know, if you've been following my notes and my research, that's been my view for some time. And I think we're kind of in that window where we should be anticipating higher rates. So it's contrary to what you might be hearing and reading from others, but I just want to kind of lay out my thinking here. Most people today are looking at the idea that the 10-year Treasury yield is below the 40-week moving average, which is the rough equivalent to the 200-day moving average. Now, it's obviously mathematically true that yields, which are currently today, they're currently at 4.29%. Yields can't get from 4.29% down to 2% without first getting below the 40-week moving average. That's obviously true. It's mathematically true. But and I believe that because it's below the 200-day average, that's why people are gaining some confidence that we're now on our way to 2%, which I think is what most people want. But what the market often gives us is kind of the opposite of what we want, unfortunately. And when you just look at this chart, this is an observation I've made several times, but I think the moment is ripe to make it again, that since this bear market started in the bond market, every time we've gone below the 200-day moving average, it's actually been a better time to sell bonds. So whenever yields have dropped as a consequence of a rally in bond prices and yields have dropped below their 200-day moving average, that's been a better opportunity to sell bonds. And I think that setup is here again. And it's not only the case that we're now below that 200-day moving average or the 40-week moving average, which has thus far proven to be a good moment to sell bonds, because it's happened enough, we now can draw a trend line that also backs up the notion that this is a good place to sell bonds. So the rally in bond yields or the decline in bond prices will really get going if we can get up through this resistance area. But I think that just looking at this setup, this is where you want to sell bonds. And I'm not quite sure what kind of a impact that's going to have on the broader market, but it strikes me that perhaps a rally in bond yields here would be supportive of the idea that stock prices can decline over the next several weeks or months, contributing to the volatility that I'm kind of anticipating, broadly speaking, in what we want to focus on during that period of time is as rates move higher from 4.29 up into perhaps the 5% area, and as that contributes to a declining equity market, is there any damage being done? And I'm of the mind, as we speak today, that the structure of the market is good enough that we want, when we get oversold, we want to be buying. And then from there, we want to then just monitor to see what kind of a rally we can get out of it and what bond prices and bond yields do after they get overbought. But as it stands right now, the condition is the market's overbought from a breadth perspective. Yields are oversold. Those two unwind. Yields go up. Stocks go down, and then we'll have our next oversold setup in the equity market. So that's kind of what I'm thinking. So there's obviously a lot in that. So obviously feel free to reach out to me if you need any clarification on that. But just to summarize, although market conditions have not been robustly bullish for some time, I think I've been detailing that almost painfully so for almost 2 years now. The market today is also not as weak as it may appear. So as we hunker down for this deeper correction in the coming weeks and months, what we really want to focus on is not the fact that we're selling off, but we want to focus on key levels for the S&P and the Qs, as well as other important trends that really need to hold to confirm this stealth bullish resilience that I believe exists just beneath the surface. A point that I also want to reiterate here as we close out, while it's usually safe to avoid the 10 largest S&P stocks in terms of relative performance versus the S&P itself, that's usually safe. It may be especially safe today, given the condition of those 10 largest companies today. Just as a reminder, NVIDIA, if it was a country, it would be the third largest country in Europe. So those are the kinds of things that you see and that are sort of hallmarks of the end of a speculative bubble with excessive valuation. So given the condition of the 10 largest companies today in regards to not regards to fundamentals, but regards to valuations, today may be the safest time in history to not own the 10 largest companies in the S&P. So at this time, we're willing to be buyers of weakness, in even if that weakness in time over the next several months and weeks and months proves to be the part of a topping process. Even if it is true and ultimately proves to be that, we still at this moment do not have evidence to say that this sell-off is going to result in a 15% decline. So this 5% sell-off, we don't believe will result in a 20% sell-off. So even if this is part of a structural deterioration that ends up resolving into a bear market in time, this leg down, this 5% leg down, I still don't think you want to be a seller into that weakness. I think if you can be tactical, you want to be buying it. If you're short, you want to be covering your shorts into this weakness, and then just continue to play this 5% swing at a time until the value line average and the S&P 500 begin singing from the same songbook. Until they're divergent as they are right now, we just want to be very neutral, buying weakness and seeing how the structure changes during the movement from oversold to overbought, and then just continue to play it 5% move at a time. So that's what I got for you this month. One last quick read of the disclosures, and I want to say thank you very much for tuning in once again. And as always, you see my email here. If I can help with anything, please feel free to reach out to me at any time. Thanks so much.